Think renting your place on Airbnb is just passive income and smooth bookings? Well, think again. If you're not factoring in short-term rental taxes, you could be setting yourself up for serious financial surprises. Hey hosts, welcome back to the channel. Today we're breaking down one of the least glamorous but most important parts of running a successful short-term rental: taxes. This video is based entirely on AirDNA's expert guide to short-term rental tax obligations. And we're here to walk you through the 6 types of taxes in the US that you need to know, how the IRS classifies your income, and how to report it properly. So let's jump in. When you operate a short-term rental, you're potentially responsible for 6 types of taxes. Some are pretty standard, others may surprise you, so let's review them. First is income tax. This is the most common. If you're making rental income in the US, it needs to be reported to the IRS. Whether you're renting occasionally or running a full-fledged rental business, income taxes apply. Second is self-employment tax. This comes into play if your short-term rental activity is considered a business, which depends on how involved you are. If you provide services like cleaning or concierge, like support, or you're managing guests actively, the IRS may treat this income as self-employment and tax it accordingly. Number 3 is occupancy tax, also called hotel tax or transient occupancy tax. This is typically required by local jurisdiction. It's a tax charged to guests, but collected and remitted by you or by Airbnb if they've automated the process in your city. Number 4 is sales tax. Some states require short-term rental hosts to collect and remit sales tax just like a hotel would. This usually applies when you're charging for additional services or if your area considers rentals themselves taxable sales. Number 5, property tax. You already pay this as a property owner, but here's the catch. Some jurisdictions may reassess your property at a commercial tax rate if it's being used as a business. This could mean a much higher bill. And number 6, business tax. Depending on your city or county, you might need to register your short-term rental as a business, and that means paying business licensing fees or local business taxes. Don't assume your rental is too small to qualify, always check. Bottom line, these taxes can vary widely by location, so even if Airbnb handles 1 or 2 for you, don't assume you're covered across the board. So when is your rental officially considered a short-term rental in the eyes of the IRS? It comes down to length of stay and services offered. If the average guest stay is 7 days or fewer, it's a short-term rental. If it's up to 30 days, but you provide significant services like daily cleaning or meals, it still counts as a short-term rental. This classification affects how you're taxed, what deductions you can take, and which tax forms you'll use. There's one caveat here: the 14-day rule, also called the Augusta Rule, allows you to emit rental income from your tax return if you rent out your property for 14 days or fewer within a year. However, you must report the income if the property is rented out for more than 14 days. You can also deduct expenses related to the rental activity if you don't meet the 14-day rule. This is where it gets nuanced. If you're mostly hands-off, maybe you outsource property management, your income is likely considered passive. That's good news for taxes, as you might avoid self-employment tax. But if you're actively involved, responding to guest messages, managing bookings, restocking supplies, your income might be considered non-passive. That reclassifies your rental as a business, which could mean paying self-employment taxes and filing a different tax return schedule. Understanding this distinction is essential for avoiding surprises at tax time. Now let's talk about the upside, deductions. If you're paying taxes, you should be taking deductions. These include mortgage interest, property taxes, insurance, utilities, cleaning fees, maintenance, and supplies. The short-term rental tax loophole allows you to take advantage of depreciation too. Depreciation lets you recover the cost of your rental real estate over a specified period of time. This can reduce your taxable income each year. Here's how it works. Property depreciation allows the value of the property to be depreciated over 27.5 years. It's important that this does not include the value of any land associated with your property. Furniture and appliances. Depreciation allows items like furniture and appliances to depreciate over a shorter period, usually 5 to 7 years. Just make sure you're tracking everything meticulously and only deducting the percentage tied directly to your rental use. If your property is mixed use, for example you live there part-time, consult a pro on how to split your expenses accurately. When it comes time to report, your classification matters. If your rental is considered passive, you'll file income and expenses on Schedule E of your federal tax return. If your activity is not passive, meaning it's treated like a business, you'll likely need to file on Schedule C, which includes self-employment taxes. Airbnb may send you a 1099-K if you earn more than $20,000 and process 200 transactions. But keep in mind, even if you don't get that form, you're still responsible for reporting your income. A few closing tips to help you stay compliant and save money. Keep detailed records of every income and expense related to your rental. Accurate records are essential for supporting your claims during tax filing and potential audits. Understand your local laws. They may require licenses, permits, or tax filings separate from federal returns. Violating local laws can lead to penalties and complicate your tax situation, so be sure to stay informed about new regulations to ensure ongoing compliance. And finally, work with tax professionals who understand short-term rentals. They can provide personalized advice and verify that you're taking advantage of all possible deductions. It's an investment that can save you far more than it costs. Taxes don't have to be terrifying, especially when you've got expert data on your side. If this breakdown helped you feel more confident as a host, give this video a thumbs up, subscribe for more short-term rental strategies, and make sure to check out the description for AirDNA's tax checklist.